Hello, everybody. Welcome to this weekend's episode of the weekly wrap. This week is episode 8, and we had a really interesting week this week. We kind of started off with a little bit of selling in the stock market. It looked like a continuation of the downtrend until we reached our resistance line that we had drawn, or our support line that we had drawn that acted as previous resistance. The stock market looked like it was going to rebound, possibly make a higher low and head back into our trend line. And then the Fed meeting at Jackson Hole really just pulled the rug out from under the markets. We were down like 3.5% on Friday. Pretty much every asset class. No industry was safe. Everything just kind of sold off deep red. So let's get into it. I want to start out just with a little bit of some of my initial thoughts. So I do think right now that markets have been pricing in like the best case scenario for the rest of this year and into 2023. We've kind of just been dismissing everything going on in Europe, kind of thinking that that'll just work itself out with Russia and the Ukraine and with the energy crisis in Western Europe. And the markets were really pricing in the best case scenario in the United States as well, saying that we would get inflation under control this year, that the Fed could begin to cut rates next year and pivot back to a looser environment. And everything was kind of just looking super optimistic in the markets, a little bit too optimistic. And I think the Fed wanted to get ahead of that this week and say that the job is not close to being done, that they're not going to let up until the job is done. I think they don't want to make the mistake of past Federal Reserve decisions of easing too quickly on inflation and then having it be a persistent problem for multiple decades. I don't think they want to get back to 70s style, 80s style inflation where they pivoted too fast and let inflation linger for a long period of time. I think they want to get it back down as soon as they can. And Jerome Powell said that he's willing to trade off pain in households and businesses if it means getting inflation under control. I think they're just incredibly focused on that being the number one priority, and nothing else is really going to bother them at this point in time. A lot of the other central bankers from around the world said something similar, that they were willing to trade off growth for getting inflation under control, and I do think that is what we're going to see. It's not really what markets had been pricing in. And I think that that's something that we're going to have to keep an eye on. I think that the markets were really pricing in this best case scenario where the Fed would pivot, where they would stimulate more growth. And I think that they made it clear that that's not what they're going to do, and that they need to get inflation under control before the economy can loosen again. So let's get into some charts now. So I wanted to talk about this one first, the shifting sentiment in the market. There's kind of this dichotomy between institutional investors and retail investors right now when it comes to being short the market, the indices in general. So if we look at this chart on the left, this is the S&P 500 net worth commercial futures position, futures positions. So really what you see here is institutional investors, they're shorts on the S&P 500 on S&P 500 futures, and you can see that they are reaching levels not seen since the pandemic. So while this could be a lagging indicator, it does indicate that institutional investors are incredibly bearish right now, that they're not expecting growth really at all, that they're expecting the market to recede really and fall pretty heavily. And that's not really what retail investors have been showing. This chart on the right here is showing net purchases of inverse ETFs. So basically what that is just showing how much are investors buying ETFs that are short different indices. And so the higher that this chart is, the more that investors are short the market retail-wise. And you can see that retail investors have really been cutting down on their short positions in the markets when it comes to inverse ETFs. I've kind of been following the price action in the markets and seeing that the markets are heading higher, and so that they want to cut back on these short positions. And in this type of environment, it could be a good idea to maybe load up on some of those short positions as the market rises, kind of inverse what you would normally do. But I think the real concerning thing here is the dichotomy between retail and institutional investors. Usually when the sentiment is this much different for institutional and retail investors, the institutional investors pretty much always win. So it is a little bit concerning when you see retail investors getting more bullish in this type of environment. So let's look at this chart here. So on the top, we have the S&P 500 charted with the 200-day moving average. And as we talked about last week, it has rejected that moving average, which is a bearish indicator in of itself. But then in the second row here, we have a momentum indicator called MACD, and it has crossed over, indicating a loss of momentum, but it has indicated a loss of momentum in overbought territory. So that's a really complicated way of saying that the trend is still to the downside here, that we're still in a bear trend, and that we may be overbought. And it kind of leads into this next chart, which is really why I wanted to bring it in. This is the S&P 500 after the MACD, which we just looked at. Differential crosses below zero, which is what we just saw, from overbought territory, which we just saw, with a declining 200-day average, which we now have in the stock market. And it's not great. If you take a look at these signals, usually from 1 to 3 months, the market is down anywhere from 2.5% to 9.5%, or I'm sorry, 2.5% to 7.5%. So it could be a short to medium term bearish signal. History would tell us that is the case. This hasn't happened since 2008 when the stock market collapsed, and we're kind of seeing similar environments right now. So in general, it's not a great time to be risk on in the markets. We're getting all sorts of indicators that would suggest that now's a good time to be short in the stock market, that now's a good time to be cautious. But also during these times, these are usually the best times to load up for the long term. So if you're an investor, when everyone else gets fearful, if we do see a capitulation to the downside, like we did in 2000 and in 2008, those are typically the best times to invest and load up on stocks. When everybody's selling, that's usually when you want to be buying, and it's how you can make great returns. Because the biggest part in making great returns is the price that you get in on, and if you can get in at lower prices, that usually means higher returns in the future. And it's kind of this inverse idea of what you would expect. When assets fall heavily, like say we go into an incredible downturn in the next couple months, that can bring up the expected return for a particular asset over the coming years. So say you want to invest in the S&P 500 and it crashes 25 to 50%. It actually increases its expected return over the next coming years, because we know that the S&P 500 is not going to go to zero. We know that over a long period of time, the S&P 500 is going to rise. And so if it goes down a large amount, it only brings up your expected return over a long period of time. So it could also be a great time to invest. And I'm not trying to scare people away from the stock market. I'm trying to say that, hey, we could see lower prices. Maybe don't load up right now. Load up at the lower price and get a higher return over the next multiple years. So let's take a look at the midterm election year averages. So typically midterm election years are a little bit lackluster when compared to any other year stock market wise, but particularly September and October can be the worst. So when you see synergies like this in indicators and in markets, there's something to pay attention to. So we have other indicators in the market saying that, hey, over the next couple months, we could go lower. Oh, also, we're in a midterm cycle, which usually pushes the markets lower in September and October. So we have all these forces working against us, price action wise. And Usually the stock market recovers through the end of the year in a midterm year, and we see great returns through the end of the year. Obviously, this situation is unique in the fact that we have a lot of problems happening, especially going into the wintertime, and especially with our friends over in Europe. We'll get into that in just a couple of minutes, but they are facing challenges that could really affect the rest of the market in a negative way. And so we might not follow this upward trend through the end of the year. We could just see more of maybe like a base, or I don't know, but it would be getting ahead of ourselves to say that we could see this huge surge. I'm not saying that we couldn't see it, but it's more unlikely than in a normal midterm election cycle because of the other factors that are pushing this market down. So this is the U.S. 10-year, 2-year inversion, basically, is what we're seeing right now, where the 10-year yield is lower than the 2-year, which basically means that the bond market is expecting events or situations in markets that would cause the Fed to loosen. And really, every single time it's crossed below this threshold for an extended period of time, it's predicted a very, very big recession or crash in the markets. So as we see in 89, 90 through 91, it preceded the recession following the S&L crisis in the Iraq invading Kuwait. In 98, it preceded the Russian gold crisis and the LTCM collapse. In 2000, it preceded the tech bubble collapsing and the NASDAQ dropping like 70%. In 2007, it preceded the global financial crisis. In 2019, it preceded the COVID-19 pandemic crash. And now we are seeing it deeper than we have even before the global financial crisis. And so we're really, really, on one end, seeing the Fed tighten really, really hard because of this inflation problem that we have. And on the other side of the spectrum, we have the bond market telling us that, hey, something catastrophic is about to happen that is going to require the Fed to pivot and loosen the economy really, really fast, as to not just blow up our financial system. And this usually has a really, really high rate of predicting crashes, as you can see, over the last several decades, and it's not something to ignore. There's a lot of factors right now that are putting tensions on our system, on our financial system, and obviously we're trying to battle inflation, and with the Fed tightening as hard as they are in a time that is so variable and unpredictable, I think the bond market is telling us that there's something to be cautious of here. What that is exactly, we don't necessarily know, but it is telling us that we may not have seen the worst, and there may be more pain to come. So this is what I was talking about in Europe. In the wintertime, Europe obviously gets really cold, and they need to heat their homes. People need to keep themselves warm. They need to buy food. And I saw this tweet during the week saying, really emphasizing how we're kind of downplaying the situation in Europe. And it says if your utility bill went from $250 a month to $2,500 a month, discretionary spending would get obliterated. The EU makes up 25% of the S&P 500's earnings. And then Britain announced a 80% hike in electricity and gas bills just today on Sunday, in a dramatic cost of living crisis before winter. Energy prices are going to be skyrocketing as Russia is threatening to cut off their supply of natural gas to heat their homes. There's a ton of demand in Europe for heat and energy, and there's not going to be a lot of supply. The prices are already skyrocketing. Germany is already in a crisis. And if we see people in Europe unable to get around this crisis and having to spend 10x on their utilities and 80% hikes in electricity and gas bills, they're not going to have any other money to spend on discretionary things, to spend on our S&P 500 companies, and they make up a quarter of the earnings in the S&P 500. So we could see that over the coming quarters as kind of this trailing effect of this crisis in Europe affecting the S&P 500. We could see earnings continue to recede before things get better. And I don't think that this is completely priced into the American markets yet. And it's something to keep an eye on, because right now it's looking dire in Europe come winter, when the weather starts to really cool down. So let's get into technical analysis. I didn't want to take too long on this video today. I just really wanted to get my points across. So let's take a look at Apple. The bullish trend line has finally broken. We were really surging on Apple. We were expecting for it to break at some point, especially once we crossed through this 170 resistance line. I did draw kind of this bearish trend line now through the top. We've kind of had this little triple top on Apple between 170 and 180, and Apple really sold off heavily with the rest of the market. On Friday, it broke through that support line that we had drawn out that was kind of in line with the trend line, and now it's kind of in no man's land. It definitely has a lot of room to fall, and if Apple sells off heavily, obviously the rest of the market is going to follow it, as it's the biggest weighting in the S&P 500. It's the largest company in the world, and I think that you can really look to Apple to be an indicator for the rest of the market, to where it's going to move. Apple can really move the entire market, and Apple's looking bearish. So that's definitely something to keep an eye on. It's not something to ignore. It could lead tech lower. It could lead everything lower. So that's something that I'm looking at. Obviously, we have this resistance drawn out around 167 would be the first kind of buying point, or not 167, 157, excuse me, would be the first kind of a little buying point. We're at 163 right now, so there's obviously room to fall even before we get there, but that's what I'm looking at on Apple right now. The S&P 500 is looking incredibly bearish. Obviously, we came to our trend line for a second time. It's the third time it's touched this trend line if you count the beginning of this bear market. And it really just crushed through our resistance that we had right here. Let me get my mouse in here. So this little green candle might have been a little bit confusing for some people. They might have seen this test of this low right here and then a breakthrough and said, oh, hey, we might be heading back here if we have a touch of the trend line and then a continuation of this little bull move. Maybe we break through the trend line and then go in a range. Maybe that's the end. Maybe the low is in. And those were all valid points, but the thing was you had to wait for the Fed to speak, I think, on Friday, because we knew that the Fed was probably going to be hawkish, that they were probably going to send markets lower, and you can't get ahead of yourself right before that big of an event. And sure enough, the market just got crushed after that. None of this really mattered. We went right through that resistance line and we're headed lower towards the 4,000 level. And after that, if the S&P 500 continues to sell off and break through here, we could be headed back towards the June lows. So the S&P 500 still looks, really, really bearish. We have this trend line still holding. We have the 200-day moving average. It's been rejected. The 200-day moving average now heading down. Just a lot of bearish indicators. The price action is telling us that we could be headed lower for sure. But again, these are great prices to get in. Even if you got in this past week, you still got in at like a 15% discount from the high. If we head lower, you'll be getting in at great prices for the long term. But for short-term traders and things of that nature, obviously it's looking really bearish. But for investors, these are obviously the opportunities of great opportunity and not things to sit on the sidelines for, because this is when you can really make a lot of money. So let's look at Bitcoin. So Bitcoin also is looking incredibly bearish. On the bottom, I have the big picture on Bitcoin, this long-term bear trend. You could probably even draw a trend line on this going through here. But it also sold off. So on the top, this is our zoomed in version of right here. So it also sold off, broke through that 21,000 resistance. It's really headed back towards that 19 to 17,000 resistance. If we break through 17.7, let's take a look at here on the bottom. We could be headed back towards that 11,000, 10,000 level right here, which has not been touched since this incredible bull run on Bitcoin. So we are in a deep crypto winter bear market cycle on Bitcoin, but I mean, talk about opportunities. This is where you can make a lot of money in the long term if you believe in Bitcoin. If you're someone like me who does believe in the use case for Bitcoin, the value proposition for Bitcoin, I mean, this is a time that even if it falls back to 10,000 and then returns to the high, that's a 7x return right there just to get back to the high. Yeah, this is something that if it goes to 10,000 or breaches below 10,000, I'll be loading the boat on for sure. These are incredible prices. And usually when Bitcoin makes a floor, it can stay there for a little bit, and it can be a good time to build a base, as we saw the last time we went into a real big crypto winter. There was a number of years where we were in a range between like 3,000 and 8,000, which in of itself is an incredibly huge range. But over the long term, Bitcoin reaching about 70,000, it was a great time to build a base, and we could be seeing another great time to build a base on Bitcoin here pretty soon. So I'm going to wrap it right there. This isn't as long as our normal weekly wraps, but I really just wanted to be concise in this one and get some of my points across. It's not looking great price action wise in the markets. Obviously, it's not all doom and gloom, but these are good times if you're an investor to be smart, to dollar cost average in, build a base, and invest for the long term. If you're a trader, obviously, the system is a little bit different. But be sure to stay tuned with us this week for the Daily Dose. I'm sure the markets will be just as interesting this week as they were last week, as we see how they react over the coming days from that meeting on Friday. And as always, thank you for listening.